Let me welcome you to today's program of The Business Coach. Right. This is a very wonderful and a good time whereby we do talk about issues to do with business. If you want to venture into business, this is a very good program for you. Or still you are still in business, you're already in business, this is also a very lovely program for you, because The Business Coach here comes with bullets in order to help your business succeed, in order to make sure that whenever you use the concepts that are shared in The Business Coach, you are going to maximize profits. My name is Precious Chikatiko, and I have The Business Coach, Professor Kingston Prince Ngwira. Welcome to the program.
Yeah, welcome again, Precious, into this program. And let me also welcome every viewer outside there into this program, Business Coach. And I believe today you're going to learn more, get more bullets, as it has actually said, so that we can see the businesses doing well, but also moving from one level to another level. So I would want also to ask you to stay tuned, and please continue watching your loved PL TV.
Last time we talked about business financing,
yes,
and we started the topic. Today, I believe we are going to go
yes,
to debt finance.
Yes, yes.
After we started with equity financing.
Yes.
But maybe before we go to debt financing, you would want to recap,
yes,
talk a few things, remind whoever is watching right now a few things,
yes,
about what we discussed in regards to equity financing.
Yes. Yeah, it's very true. We actually talked of several issues. One of the issues we talked about was the term the term capitalization, but also the term gearing, that will also be linking up in terms of the debt capital. And we were saying that we should also know the accounting equation, which is assets is equal to capital plus liabilities. And in many cases we are saying that the capital there, that's the equity part. The liability is the debt part. So it means the business is financed by either equity capital, your own funds, or possibly debt capital if you think of going to go and borrow. But I also said that normally businesses do not start with the assets, which are your own possessions, talking about either fixed assets and current assets. Total assets is equal to capital plus liabilities, but sometimes it only starts with the assets is equal to capital. It does not start with assets is equal to liability, because it means you everything that you have in the business you have actually borrowed. So it will be assets is equal to liability. So because not many people, including banks, that can borrow someone who has nothing. Sometimes the banks, they say, okay, give us the financial statements, things like income statement, the balance sheet or statement of financial position, but also even the cash flow statement. And these documents may be for a starter, maybe might not have these documents, because maybe the bank is looking for 3 years of financial statements. You have just started today or last year, so it means you don't qualify. But also they'll be looking for what we would call collateral, all right? Yeah, surety, or maybe the assets whereby in case someone is in default, they can grab that property and then they would want to sell it to recover their money. So because you are just starting, maybe you don't even have those type of assets. All you have is your brains, and you have produced a business plan, and therefore you don't have anything. So you see that for the bank to rely or to give loans to borrow someone who is just starting, sometimes it's very, very difficult, because they deal with what we call risk. And they want to go where the risk is very low. So where there's risk, the risk is very low, that's where they would want to actually invest. If they see there is no risk, they will be able to run to you to say, please come and borrow money, because they know you are able to pay, and there's no risk. If you are in default, they can actually get 1 or 2 items from you. But if you're just starting, sometimes it's in many cases maybe it would be like assets is equal to capital, meaning that one starts without having borrowed funds into the business. So when the business grows or expands, then it's when now we would say assets is equal to capital plus liability. So we looked at the side of equity and your own funds, and where we were saying there are 5 areas in which you can be able to bring in funds of your own without necessarily going to borrow from somebody else. One of the areas we talked about was the savings, that one would be able to save his own funds. In this case, we are thinking that that entrepreneur maybe is actually working. Let me say this, that if somebody is working, not necessarily that he should leave work and go for entrepreneurship. He can be managing that other business while he's actually working. And it is very good, because sometimes we people, we grow and we come at a time we need to retire. Sometimes when retirement comes in, it is at a time when you still have strength, all right? You retire at 60, you retire at 65. You might still have strength, but because the laws are saying you retire 60 or 65, then you leave the working place. So at that time, you can find your business which maybe has grown over time, and then you proceed and life goes on. Other than maybe starting the business when you retire, you find you haven't built a house, and then all the monies go there, and then you want to start a business, it's also demanding. You find that it's so stressful. So when you do it while you are working, it is actually much better. But also in terms of wealthy creation principles, if somebody is wealthy, we say that he has more than one source of income. He has more than one source of streams of income, so that if somewhere the sources of income they are cut, or maybe there are challenges to get it, you can survive by the other sources. All right, that's what we call wealth creation. So even when you are working, you can have a business somewhere, somehow, and maybe you are working, you find that maybe salaries have delayed, then you're not affected, because you have something that can actually help you. So those wealth creation principles, they also demand that even somebody who is working should also be thinking of maybe having a business somewhere. So we talked about savings. So depending on the nature of the business you want to do, how much capital are you thinking to invest in, you can give a time frame and be patient to make sure that you keep that money over that period of time. Maybe you're looking for 10 million kwaja capital, 5 million kwaja capital, and your salary is only 200,000 or 300,000 or whatever amount of money, but you cannot get that within 2 days or 2 months. So if you're looking for 5 million, you need to save over a period of time to make sure you reach at the capital that you want. And then when you have it, then now you talk about your budgets, or to give you guidance, what you're going to do, how you're going to use the money, in which area you're going to invest. Then you can invest there. And we talk about preparation, which is very, very important. And then when you prepare very well, you know to say, maybe in the next 3-6 months, maybe rentals or maybe salaries and other operational costs, we're going to spend so much. So you keep that money aside. And then you find that over time, then you're not having possibly some challenges. So number one is savings. Number two, we talk about getting money from a sponsor. All right, a sponsor is somebody whom you might approach with your good business plan, and then you convince them to come into the business. There could be two types of sponsors. One type of sponsor is that they give you the money, maybe will not ask anything, say it could be a brother, a sister, or an uncle, or anybody else. Okay, you're looking for 200,000, 1 million, this is the money, start the business. So you have those type of people. But there are also other types of sponsors, whereby they would want to have a benefit from their investment. So you strike a deal. Sometimes, okay, from your sponsor, the money that is coming in, you also be getting some profits at the end of the financial year. So part of the profits, you can agree how much profits, depending on what we have made in terms of profits, how much you can actually give to the sponsor. So you might not be on a salary. The salary will be for the entrepreneur, but the sponsor might get only the profits at the end of the financial year. So in short, you have a sponsor that might actually come in. And number three, we talked about the sale of fixed assets. Yeah, so I was saying maybe if you have got other assets, you have got cars, maybe 2 or 3, you can sell one. You say one car, 3 million, that could be a good money to start the business, all right? Or maybe you have 2, 3 lands, you can sell one land at 5 million and whatever, and then that can be a good way of starting the business. So when you have some assets which can give you good value of money, you can actually sell, and then you can have the money to start your business. We also talked about reserves. Sometimes you have money that you're just keeping somewhere in fixed assets and fixed deposit account, for example, or any other type of account from the banks. So you have your reserves, and those reserves are also accumulating some funds. Over time, you would be able to use those reserves and bring them into your business. If a business is already there, if you are growing, maybe you want to start another business, maybe you have profits. So what we call retained profits. So when you have profits, you can, as an entrepreneur, you can decide how much you can take from the profits, and then the other part can be taken back to the business. So maybe you've made 5 million profits. You will say, okay, 3 million should go back into business. Then I will actually take about the 2 million. 2 million you can invest in another business from the existing business. So we have all these 5 areas where you can be able to have funds to finance the business, not necessarily going to somebody and borrow.
Welcome to the Business Coach. This is another wonderful time whereby we have the Business Coach in the studios, and he talks about issues to do with business. So if you are an entrepreneur, this is a very, very good program for you to be watching. That is, if you want to venture into business or you are already in business. So this is a very good program for you. My name is Precious Kikatiko, your host, and I have the Business Coach, Professor Kingston Prince Nguira. Welcome to the program today.
Thank you so much. And maybe let me also take an advantage of welcoming the viewer into this program. And we want to say we are back into the program, but also we are loaded. As usual, we have got guns with bullets. So we want also to give bullets to the entrepreneurs so that they can be able to shoot on their own. And today we are also loaded, and I believe whenever they take whatever we'll be able to discuss in this program and put them into applications, their businesses are bound to boom. Bound to change. But also those that want to aspire to go into business, they should be able to know how to do it, when to do it, and then they can make their lives easier.
We have been talking about business financing.
Yes.
So today we are also going to proceed.
Yes, because we have so many things that we can talk about business finance. So remember, we've talked about 2 types of finance: the equity finance, using your own funds, and then the debt finance, if you do think of going and borrow, maybe from financial institutions or financial markets. Yeah, so in that aspect, we have lots of things that we can actually discuss. So we don't want to rush, so that we give the viewer, we give the entrepreneurs the best out of it.
As a business coach,
yes,
which one would you prefer between debt finance or equity finance? Between the two.
Between the two. Okay, I would answer that question in 2 perspectives. I would really favor for the equity finance, because equity finance, you are using your own funds as an entrepreneur. It is all a matter of preparations, that when you're preparing, you don't have to rush starting. So that you have your equity finance with the various ways that we'll discuss in this business coach, and then you can start. Because if you rush, you have hiccups, and then you'll be able to be forced to go and borrow. Because for example, one of the ways in which you can raise finance
in terms of equity finance, your own funds, is through savings. Okay? Yeah, savings. So if you're working, for example, you can be saving depending on how much you'd want your startup capital to be. So this means that we would call it sky blue thinking or backward thinking, where you go to the end and then you come back. So when you go to the end, you know to say, okay, this is what I want. This is the capital that I want. Okay, I want 5 million. And then you go back and start now crafting the strategy or the steps to arrive at the 5 million. So in this case, it means you are actually looking at issues of financial deficit. Yeah, the difference between the available and the expected. So if, for example, you want a capital of 5 million, and then you have only 500,000, all you are looking for is 4.5 million. So that's the financial deficit. The difference between the available, which is 500, and the expected, which is the 5 million. So it is that one that we say, okay, I will be actually saving. So I would want to say, to answer your question, between equity finance and debt finance, which one is the best? I would want to say equity finance for several reasons. One, you're using your own funds, and nobody is going to harass you. Two, if you go for debt finance, you are in default, you're not paying. Sheriffs will come to grab your property. Or maybe, depending on how much one has pushed in, the money you have borrowed. If you have the borrowed funds are more than what you have, like in terms of assets. You have 10 million assets, and then you are borrowing 30 million. Then it means that business, somebody can say, get your 10 million, I'm taking over the business. So it means it will not be good for one to go for the debt finance. That's why when we reach at that aspect, discussing about debt finance, we also look at how much can you borrow, all right? It's not you have 30 million assets and then you are saying I want to borrow to, my business, I want 100 million.
But maybe borrowing is borrowing. You can borrow any amount.
The thing is, no one can borrow you more than what you have. If you go to the bank, nobody will give you 100% of what you want. You are looking for 30 million, they will not give you 30 million. They will say, to 2 million. They will not give you that, all right? Because they are also in business, they are dealing with issues of risk. And the risk they are dealing with, they want to invest where the risk is very low. And where there is no risk, then they say that's where we're going to invest, all right? Yeah, so equity finance would be the best. So I wanted to say, if you are saving, we say that the savings is a perfect substitute of borrowing. When you are actually saving, is a perfect substitute of borrowing. Which means if you are saving, you cannot borrow. But if you don't save, then surely when you are in trouble, you are in financial hiccup, financial deficit, the only option is to borrow because you're not saving. Yeah. So in short, I would favor for equity finance, other than maybe debt finance or possibly borrowing. Of course, maybe sometimes times come whereby you are equity finance you don't have. Okay, if it's a limited company, the company is looking for equity finance. The funds from operations, maybe the business is doing very well, they can try possibly to look for reserves or savings. They haven't saved anything, or they go to the investors or shareholders, they also don't have the money, so they have exhausted all the ways on equity finance. That's when they can now go for thinking of borrowing, maybe an overdraft, bank overdraft, or maybe a simple or short-term loan. So I believe that to go for equity finance is actually the best. Now, in last time, I think just to recap some few things, we are trying to say that there is what we call an accounting equation.
Yes.
Assets is equal to capital plus liability. Assets is equal to capital plus liability. So what we are saying is, what are assets? Assets are possessions, all right, of the business. And the assets are divided into two. You're talking about the fixed assets and the current assets. And when we talk of fixed assets, these are long-term possessions like cars, land, buildings, furniture, computers, all right, in short, equipment. So all those are long-term. Those are fixed assets. But you have also what we call current assets, where you have debtors, you have cash at hand, you have cash at the bank, you have also stocks, others call it inventory. So you've got these four things: the debtors, the cash at hand, the cash at bank, but also inventory, which are stocks. Because the stocks, if you have got goods in the stores or warehouse, anytime you sell them, you can have cash. So that's why it's called current. Cash at hand, you already have the cash. Cash at the bank is a matter of just going and withdrawing the money, and then you start using it. Debtors, these are funds that are with your customers. You sold the goods to customers on credit. Maybe you had some agreements, 30 days or 60 days, and maybe they gave you an LPO and you invoiced them. So you know you have got your money you have already made because of those sales. So when you go and collect that money, when you have debtors, anytime you can collect that money, you have cash. So that is what is called current assets. So current assets plus fixed assets, you have total assets in this case. So the total assets is equal to capital plus liability. Now liability is what we are saying debt. While the capital is what we are saying equity. Your own funds, that's the capital.
Okay.
Plus debt plus liability, that's the debt. So we are saying, this is what we are saying that another term in financial management which is called capital structure. Capital structure. Capital structure means how a company or a business is financed. It is financed either by equity, capital, or debt, capital, or both. All right? Yeah, or both. So, of course, I was trying to say, when businesses start, they don't normally start with the assets is equal to capital plus liabilities. Because the liability part, somebody to give you the money to borrow you the funds, sometimes like the banks, they'll look at some documentations. One of them would say maybe financial statements. So they give us financial statements for the last 3 years. So you are talking about income statement, which is profit and loss account, the balance sheet, which is statement of financial position, and then you have cash flow statement. Now, if you're just starting, where are you going to have this? You are just starting now, and they are saying we want them for 3 years.
You don't have.
Then it means you are not qualifying. But also on the balance sheet, on the statement of financial position, that's where they'll find those items I was talking about as assets, computers, cars, and whatever, so that when you are in default, they can say, which one can we grab here and sell and recover our money? So if you're just starting, it means you don't have assets in many cases. All you have is a business plan, a document, but you're looking for money. So this is why it is very hard for banks to give out money to businesses that are just starting, because they think there is too much risk and they would be able to lose their money. They will say open the account first. So we should be seeing how your account is swinging, maybe for 6 months or 1 year. Then we can consider that. So you say, you know, you want the account to be swinging. Where will the money be coming from? I want the money from you first, and then I can make operations, make business, and bring the money to the account. But they will say, no, we would want you tell us who are your customers. You ask me about the customers, I will find them now. So those are the different types of thoughts between the lender of finance and the borrower, who is in this case an entrepreneur. So because it's difficult for one to get the capital, the borrowed funds, when starting the business, many businesses, they start with the assets is equal to capital. Assets is equal to capital. So today I want to discuss that assets is equal to capital, that equity, your own funds. How do you raise them without borrowing? That's what we want to discuss today. And then in subsequent program, we will now go for the borrowing part, which is now debt capital. What is it? The cost of capital, which is cost of borrowing, issues of interest. How do you pay them? What type of, you have the what you borrowed, the principal paid back to the bank, the interest paid back to the bank, and then you have your own profit. What type of business is that? So we need to look at all those, because it's not everywhere you can invest. The other businesses you make losses, so you don't have to go into the businesses you'll be able to make losses. So we are looking at assets is equal to capital. Now the capital is on the right hand side. In financial accounting, we have an accounting rule which we call debit the receiver, credit the giver.
Meaning?
Meaning that for every transaction in the account, there must be a debit entry and a credit entry for every transaction. For instance, the capital, the owner of the business, is bringing money as capital, all right? He's taking his money into the business, but that money is going into the bank. Well, he is taking that money, put it into the bank. So we have two accounts there: the bank account, which he has opened, where that capital is going to be, and the capital account. Two accounts. So there will be two entries. Now you debit the receiver and you credit the giver. The one that is giving, you credit, you put it to the right hand side. The one that is receiving, you put it to the left hand side, because he has received. He has. So when you say I have got a credit, it means you have you have something. Now if the money is a capital, it means him is giving. So we say we credit the giver. So the account has got a debit and a credit, the left and right. So when somebody is giving, the money is put on the credit side, because you have debit and credits, DR, CR. So at the CR, that's where you put your money when you put the figure when the account is giving. So the other account that is receiving, like in this case the bank, the money will be on the left side. So the capital account is giving, you credit capital account, and then you debit the bank account.
Credit
So
is single ngole.
sorry?
Credit is single ngole.
No.
But now,
No. If you say I have got the credit in my phone, does it mean you have ngongole?
No.
You mean you have the credit? Yeah. The invoice, for instance, if you invoice someone, you are going to say, I will debit your account. I will debit you. That's why it's called, you're talking about debtors. Ngongole's minutes. Yeah, so, but that ngongole, in terms of debtors, it's you who is looking at the customers that you have sold goods to them. But them, when they are looking at you, they are looking also at ngongole, but the creditor. Yeah, so creditors, they are like suppliers to the customer. So that's why they say creditors, all right? But here we are not talking of creditors. We are talking about where the money is coming from. Where the money is giving, you credit that account. Where the money is being received, you are debiting that account. So what we are saying is, if assets is equal to capital, capital is giving. It is giving where? To assets. So if it is 20 million that has been given, it's on the right side, on the credit side. Then now on the debit side, you have now assets, maybe 20 million, 5 million, you have bought a car, 2 million is at the bank, 3 million, 5 million, maybe you've bought some stocks, and maybe another money you have got on cash. The total of that, you have the 20 million, and then you have got fixed assets and current assets from the 20 million. Because another one is in fixed, the computers, the vehicles, another one in the bank, that's current assets, cash, stocks. So it's actually those assets that we have actually talked about. So in short, when an entrepreneur has money, a capital, that money will be converted into those assets. He has put the money into the business, the money is in the bank, and he will be withdrawing from the bank. You see? So when he's withdrawing, the bank is giving. Is that right?
Yes.
So you credit, because you credit the giver, the principal. Debit the receiver, credit the giver. So if he's withdrawing the money from the bank for use, the bank is giving. It means there must be some, the bank must be credited. What we are saying is that you have on the left side your money, on the right side, on the payment side, then it means the money is actually going out. But when they are looking at those funds as the bank, in many cases, if the account is in credit, it means you have the monies in the bank. But to you, when you are talking about receipts and payments, the payments are on the right side, the receipts are on the left side. So in this case, what we are saying is it is difficult for an entrepreneur to go for borrowed funds and you only start with your own funds. That's capital is equal to assets. So the question is, how do we raise the funds that are of that equity nature? We're talking about 5 ways. Number 1 is the savings. If you are working and you want to go into business, you can be saving from your salary. and you must have an amount which